Welcome back to Wealth of Options. My name is Orlando Lopez, and today we're talking about something very real for many Canadians this year, which is layoffs. Tech, the media industry, real estate, finance, manufacturing. We've seen the layoffs across the country. And when someone loses their job, they're not just dealing with the emotional shock, they're also suddenly facing many financial decisions and major pension decisions. So let's talk about what really happens to your pension when you leave an employer. Now, first, let's acknowledge something. Getting laid off is overwhelming. You're trying to figure out your next steps, updating your resume, maybe even dealing with applying for EI. And then, on top of that, you get a big package of paperwork about your pension. Now, most people freeze and they say, I'll deal with this later. I'm too stressed. But this is exactly when calm, informed decisions matter most. Because what you do with your pension now affects your retirement 20 or 30 years from today. Now let's start with the most common scenario today, a defined contribution pension. If you're laid off, your employer stops contributing. The account becomes yours, but you can't leave it where it is forever. You're given a choice. Transfer it into a locked-in account, or sometimes to a new employer's plan if they accept transfers of a defined contribution plan. Now that means you can't cash it out like an RSP and get access to the funds, especially depending on your age. The government wants to make sure it's preserved for retirement. And the biggest mistake I see is people leave it where it is because they're overwhelmed. And years later, they forgot about it. It gets invested poorly or sits in a default fund that doesn't match their needs. Now, what if you have a defined benefit pension? When you leave your employer, you're usually presented with two options. Leave the pension where it is, and you'll get a predictable income at retirement. There's no market risk related to the stock market. It's simple. Option two, taking the commuted value. That means you're taking a lump sum of the future pension payments and transferring it into an investment account that you now control. Now, people often choose based on emotion, but you need to choose based on math and personal circumstances. Leaving it gives you stability. Taking a commuted value gives you control. But there are some tax implications as well, unlocking limits and long-term income considerations. So this is where good advice matters, looking into the details specific to your situation, whether you are married or single. These can make differences. If you had a group RSP or group tax-free savings account, these are more straightforward. You can transfer them into your personal RSP or tax-free account at your financial institution with no tax consequences. But again, many people forget and leave them behind in an old employer plan with possibly sometimes high fees and limited investment options, which doesn't give them the full scope. Now, there's a question that I get all the time. Can I unlock my locked-in account because I got laid off? The answer is maybe. Depends on your province and the rules. Now, some provinces allow unlocking for financial hardship, low income, high medical expenses, or if the account is below a certain threshold. Now, layoffs don't automatically trigger unlocking, but they can lead to circumstances where hardship rules do apply. And that's something that we have walked people through. So leaving a job, whether involuntarily or by choice, forces you into a moment of needing financial clarity. Your pension, your group RSP, your savings, they're all suddenly in motion. Those decisions, they deserve time, not panic. Now, in the next episode, episode 4, we're going to talk about something that affects almost everyone with a pension trail. Locked-in accounts and consolidation. How they work, how they differ from RSPs, and how consolidating accounts can dramatically simplify your retirement plan. Thanks for taking the time to listen, and I'll see you in episode 4. Feel free to share this with others that it might benefit. Thank you.